Hey guys, my name is Flynn Holbrook with TruckSpy. I want to thank you for joining us for our second session in our summer webinar series, specifically geared for FedEx contractors. We know that you're all extremely busy, so we appreciate you carving out an hour to hang out with us. We're going to cover some really interesting stuff today on finance and tax. I've got two excellent guests who I will introduce in just a second. First, I want to tell you a little bit about TruckSpy in case you're not familiar. We help FedEx contractors automate their IVMRs and their minimum wage compliance. So that's all the reports that FedEx requires of you. And we can do a lot of other stuff if you're not a FedEx contractor. So that's a little bit about us. Our website's truckspy.io in case you are interested. I want to give you just a couple of ground rules for our session today. On the right-hand side of your screen, there's a pull-out, and you've got three tabs: chat, polls, and handouts. We won't be using handouts today, but feel free to use the chat. So post questions here. We're going to mark them as questions. We're going to answer them throughout the session. And we're going to ask a couple of polls in the polls tab today. So feel free to answer those honestly. It's going to help us inform our discussion. So I think with that, I'm going to introduce our guest. Actually, before I do that, I'm going to throw out a poll so that while I'm introducing, you guys can start answering. The question is, do you have a tax strategy in place for 2021? And this is going to be a panel discussion, so this is going to kind of inform how we flow today. So I want to introduce our guest. We've got Amy. Amy's a partner at Mueller. She has 17 years of public accounting experience. She specializes in national and global business affairs, including tax issues. So her client portfolio really, it's pretty broad, guys, covers a lot of industries: manufacturing, distribution, transportation, technology, and services. She actually has a lot of experience in transportation, and she has worked with companies like PowerPool, Black Horse Carriers, and Nationwide Rail. So some pretty major players in transportation. So we're going to talk with Amy a lot during the first half of this session about tax. Also want to introduce Craig. Craig is actually a friend of mine. We went to school together. He works with Cache Valley Bank in Utah. He is very experienced, kind of all around in the credit space. So credit, finance, and M&A. He's written a lot of credits for all sizes of transportation companies. He's really familiar with both equipment and M&A type financing. So we're going to dive into that just a little bit. So thanks for your poll responses. It looks like 58%, 7 out of the 12 responses don't have a tax strategy. So it sounds like we've got some value to uncover today. So yeah, absolutely. So let's dive in, Amy. I think it would probably be helpful for everybody if you wouldn't mind. Can you just kind of start from the top? Like, in your experience, what should a transportation or trucking company be considering in a tax strategy?
Well, first of all, thank you, Flint, for the introductions, and I'm glad to have everybody on the call with us today. So I hope you find this very valuable. As he said, as you have questions, just drop your questions into the chat area, and we'll try to address those as we're going along. As far as some of the tax strategies with my clients, it's always how can we reduce the amount of taxable income that we have, or if they're looking for losses, maybe they need to do carrybacks or something like that. How do we increase our NOL to be able to carry back something like that? There's been a lot of growing demand, especially since COVID has occurred. With my transportation clients, they're just booming. So they're looking for any sort of ways to reduce the amount of taxable income that they're incurring this year. And they don't see that slowing down in the near term with how everything's changing. People are doing things more remotely. People are buying tons of products online that is being shipped and delivered to people in short periods of time. So with all of that, most of my focus on the discussion is going to be around making sure that you're utilizing all the exemptions in your industry that you're allowed to have, all the credits that you can obtain, and all the deductions that you can get. And with that, what I have seen is a lot of clients forget about the federal incentive for fuel tax credits. Now, given that you're in the trucking industry, you may or may not know that, or it just hasn't been brought to your attention, but there are many different fuel tax credits available to you. And there are simple forms that you can file in order to obtain those credits, whether you can claim those refundable credits on your taxes when you file your annual filing, or there's a separate form that you can also file separately to get those credits. If you haven't been doing this, there is a way to retroactively obtain the refunds associated with fuel tax credits should you qualify for those. Now, it's just not any type of fuel. So any your typical propulsion motor doesn't qualify for these types of fuel credits. But if you think about the things that you use in your business for off-highway purposes, or you're using refrigeration units, I see that a lot in the transportation industry. That type of stuff is it's not a propulsion motor. So that fuel used for the refrigeration unit would be available for credits. If you're using propane, for example, there's a really good credit that you can get for that. However, it does require an IRS on-site visit, and sometimes that makes our clients a little bit nervous because they don't want anybody coming around and poking their business all the time. But if it's significant enough, it would definitely be worth it and bring a lot of value to you. Something else that we'll talk a little bit more in detail would be accelerating depreciation deductions for assets that you're purchasing. So I won't mention that right now. There's also taking a look at your repairs and maintenance. What I see a lot of times is clients will be capitalizing costs that are really more of a repair or a maintenance type cost. It doesn't prolong the life of the asset that you're using. So there's a lot of opportunities to scrub fixed assets and find ways to even take deductions that you had capitalized in a prior year, carve those out, do a change in accounting method to benefit those deductions in the current year. Let's see, some of the other things. Work opportunity credits, those are still available. It was retroactively put back into play again after the last expiration. So you can essentially get a credit of up to $9,600 per employee that as a company you hire that are in a special group of people, such as veterans, handicapped people that you may hire, or welfare recipients, even felons and other qualifying persons. There's a list of probably about 8 to 10 that would qualify. If you hire these particular individuals, you can get a credit of up to $9,600, but you have to file a lot of stuff in advance and with a certain time period. And I think that the day is 28 days that you need to file the work to get approved for that, to get the credit after you've had them working with you for a certain period of time. Another thing for trucking companies, making sure that you're utilizing any rolling stock exemption. And what this does, this exemption that you would apply for would relieve you from having to pay sales or use tax on certain purchases that would typically have sales and use tax charged. So the purchases of motor vehicles, the trailers and things like that you're purchasing, even parts that you're purchasing for your repairs and maintenance type work. You could, if you provide the exemption to the person you're purchasing it from, you wouldn't have to pay the sales tax on that, but you're using that in your business. Current deductibility of tires, a lot of times at your trucks and trailers that you're using would be capitalized. Sometimes people miss that the tires associated with that are really considered a separate asset. So if those tires are going to be eaten up within a year, which is very typical, you can deduct those in the year that you purchased your tires rather than capitalizing it and depreciating it.
Hey, Amy, quick question on, so you can so if I go buy a new truck, I just want to make sure that I understood what you just said. I can write the tires off, the first year, assuming, and I know I could use bonus on the truck, right? But the truck has a longer lifespan, so I can write off the tires. Can I also do that with FET? Whatever I pay in federal excise tax on that truck?
Yeah, you should be able to do that as well.
That's that I think a lot of people probably miss that. That's actually quite a bit of money that you could take the first year.
Yeah, all of my clients take that tires deduction in the initial year, even though
Yeah.
there's a chance that the tire may be used for more than a year, but the likelihood of that, you know, depends on your level of risk that you want to take and what year you take a deduction. So, but 9 times out of 10, they deduct those in the year that they're purchased.
Wow. Hey, Amy, you also mentioned that, and I'm going to lose the name of it. If I hire veterans, I hire certain groups, I get this credit. How much paperwork is involved in that? And in your experience, if I have 1 or maybe 2 employees in that group, is it worth going through that headache to get that credit?
It depends on the state, because each state is going to have somewhat different rules in how you apply to get that qualification for them. It's relative. I don't see it soaking up a lot of time to get the paperwork done, but if you're working with somebody and they're not too familiar with the rules, sometimes you got to do a little bit of research up front to get acclimated to that, depending on the state, so that you're filling out the right applications to get it certified and qualified.
Right, but that's a credit. That's not a deduction, right? That's a credit.
Exactly. Mm-hmm.
Yeah, so that's take it right off your tax bill.
Exactly. And I see that a lot of people aren't taking the benefit of that because they're just not thinking about, I've hired this specific type of employee and thinking about this credit. It gets missed a lot.
Right. That's that's pretty cool. And I'll bet a lot of people in this webinar. I didn't know that. I owned a trucking company. I had no idea that was a thing, and I probably could have taken advantage of it because, you run into a lot of drivers that, at one point had a criminal history or that were a veteran, mm-hmm. or that, perhaps families on welfare. That's great. That's free money. So you mentioned depreciation, and I don't want to get real technical. I think, or I kind of do, maybe just a little bit. Can you kind of give us like a high level difference between bonus and 179? I think a lot of people get those confused, and they have to class their assets, mm-hmm. right? And you have to treat the entire class the same, is my understanding.
Exactly. But before we get into that, there was one other thing that I wanted to mention.
Oh, sure. Sorry.
With the audience, I'm not sure, who is doing this or somebody's been thinking about this, but being in the trucking and transportation industry, there's a lot of risk associated with what you do. If there's an accident, your goods get destroyed. So I see a lot of companies that are doing their own self-insurance. So they've got these huge accruals on their books that they can't deduct for tax purposes. So what we do is have discussions with our clients about captive insurance, where you can go in and pool your risk with other similar people in your industry. So you're able to deduct the premiums that you're paying on the insurance, and possibly with any earned and increased income, earnings can be distributed out to you in the form of a dividend. So you're deducting your premiums at ordinary income tax rates. You later, if there's profits in the captive insurance company, they distribute that out to you as a dividend, which is taxed at capital gains rates. But we don't know what's going to happen with those. We hope they stay low, though.
So, Amy, and I've got just a little bit of experience with captives. I think it's fair to think of that almost like an insurance cooperative. Mm-hmm. Right? The profits get redistributed, everybody shares in the losses. And I know a lot of our customers or a lot of folks in this webinar probably don't have to worry about liability insurance because FedEx picks up the tab for that. But your physical damage can certainly get ran through a captive. And that's something to consider. And there are several of those that exist that you guys could work with. We're going to have another session actually on optimizing your insurance. And we're going to talk a little bit about options for captives during that session. So you teed me up like perfectly for that, Amy. I appreciate it. So yeah, that was nice. So back, and I want to just circle back. Depreciation in 179. Are you ready to go there, Amy?
Ready to go there. So
okay, perfect.
I will try to, it can get a little bit complicated and it's hard to remember the rules for one versus the other. But both bonus and 179 are accelerated forms of depreciation. Well, actually 179 is considered a deduction rather than a depreciation deduction, but nonetheless, both of them are deductions. When you purchase fixed assets, you automatically, if it's a qualifying asset, have to take bonus depreciation. And with the tax reform changes, now you can take that on new and used asset acquisitions for assets with a life of 20 years or less. Whereas Section 179, you actually have to make an election to take that deduction on certain assets. And for 179, you could take that on asset class lives over 20 years, but things like real property do not qualify to take 179 deductions on. With bonus, if you decide that you don't want to take all of that accelerated depreciation in this year because you want to be able to take deductions into a future year, you can make an election out of bonus because it automatically applies. You have to elect out if you don't want to take it. And when you do that, you can't just pick and choose which assets you don't want to take bonus depreciation on. So if you purchase 10 trucks and you want to elect out, all those trucks are 5-year, you have to elect out of taking bonus on that entire 5-year class life of fixed assets. Not just the trucks, but any other assets like computers, things of that nature that would be a 5-year depreciable period. You have to elect out of all of those. The benefit of 179 is I can pick and choose what assets I want to take depreciation on or I don't want to take it on, that you want to take 179 deduction on. So that's a benefit of bonus versus 179. You can mix and match and commingle what you do for bonus, what you do for Section 179 in a particular year. For 179, if you have losses for the year, though, unfortunately, you can't take 179, so you won't be able to pick and choose. For bonus, if you have losses, you can still take bonus depreciation for a particular year. So that's something really good to know.
And that would just create an NOL, right, Amy, that you would carry forward, correct?
Yeah, if you create a business NOL by taking those full deductions, you can either carry that forward, of course, or if you have prior year taxes that you'd like to recover, you qualify to carry those back. You can carry those back.
So that, I mean, this is like a pretty big decision that a trucking company has to make, right, in their tax strategy. Are we going to, by default, just take bonus, or do we want to push some of that, I guess you'd call it depreciation or deduction, out to future years, right?
Exactly. Are you trying to build up, are you trying to reduce your taxable income as much as possible so you can take the earnings that you have and continue to make capital investments in your business for operations? You want to accelerate your deductions. But if you're expecting, business to change in a different way and you just want to be able to ratably get an even deduction as your income increases too from year to year to year, and you might want to just not take, you want to elect out of bonus and not take 179. And right now it's going to be changing here in the future, but our NOLs are going to revert back to what they were with the changes with tax reform, which would limit your carry forward to offset taxable income in the future at 80%. So you'd still have that 20% to pay tax on.
Wow. Okay. And so that was actually that was going to be my next question is how should we think about bonus and 179? I mean, what's the reason that I would want to push my deduction out? It would really only be if I have expectations of tax rates increasing or the ability to use NOLs goes away or is decreased, right?
Yeah, exactly. Mhm.
So what's your view, Amy, on where we are, where our federal government is with our regime change? What's going to happen with tax, with general income tax rates, and how should we think about? I know that that's a
Yeah,
really
I
rough
know
question, but
that's one of those, there's a lot to consider with all that, especially with the changes in administration. Um, there's a lot of fear out there, and I worked on Black Horse Carriers, which has recently, when you see the trucks on the roads, you're probably not going to see the Black Stallion on these trucks over the course of the next 2 or 3 years because they sold their business to Penske. It's public knowledge now, so I can tell everybody that. But they sold their business because they were aware of what Biden was trying to do with the increases in taxes, and they just weren't willing to take that risk. So they wanted to get out what they could, and now they're more focused on what are they going to be doing for retirement in the future year. But it's hard to say if Biden's actually going to be able to do all the things that he says he's going to do. Will there be some changes? They're talking about the capital gains tax rate going to your maximum ordinary income rates if they change it from 37% for individuals up to 39.6%. They're saying we're going to tax your capital gains rates at that. And if it's subject to the net investment income tax of 3.8%, you're looking at a 43.4% tax on capital gains, which is really hefty. Now, I don't think that's going to happen. I think it's going to be some form of that. Maybe those tax rates will apply. But for example, in Canada, for capital gains, they tax you at the ordinary rates, but they give you a 50% exclusion. And in the US, it was before my time. I was talking to another partner of mine. They were like, yeah, years and years and years, like decades back, they actually had an exclusion. The normal rates applied, and then they would just apply a percentage to that to decrease your taxes. You know. So,
interesting.
but it's
So
really hard to say what's going to happen and if all of these ideas are actually going to come to fruition.
and I guess maybe just to unpack that, just so that I'm clear on what you just said, Amy, and I'm by no means a tax expert, and I don't think Craig is either. I see Craig with his brow furrowed. Um, so if if I own a trucking company and our expectation is, and most of these businesses, as I'm sure you know, are flow through entities, right? So
Yeah.
if the expectation is that the overall income tax rate is going to increase, then I might want to push out some of my depreciation to future years, especially with that change in the NOL. And then I guess capital gains is almost a separate issue, right? Because that really only applies, and I could be wrong here, but that really only applies when I sell my business, probably in most cases,
Most
correct?
cases, yeah, sell your business or you own other investments through the company that's of capital in nature.
Got it. Got it.
But,
Okay.
but,
So,
but yeah, if you're expecting tax rates to go up, and then that whole 80% limitation that eventually is going to start applying back to your NOLs again, you would want to not accelerate those deductions so you can spread that out into future years and deduct those to keep your tax bill a little bit lower.
got it. Okay. That makes a lot more sense to me. So I think what I want to do is a call for questions for Amy. So if anybody has tax questions, I want to encourage you to put them in the chat, and we're going to answer them. I kind of have another question for Amy, and that is, tell us about working with an accountant. So you're obviously an accountant. You've worked with a lot of clients. What's kind of the most efficient way to work with your accountant and get the most value and get your taxes right?
Yeah, for all of you on here, you're all in this business together. Um, your accountant that you decide to work with really needs to understand your business and the industry that you're in because they're going to be able to bring the most value to you if they know the industry really well. There's a lot of in the trucking and transportation, there's a lot of uniqueness in it, especially when it comes to state and local taxes. So you could be creating exposure for yourself that maybe your sole practitioner really doesn't know. But uh, I don't think accountants or clients meet often enough. I would have to say, the once a year thing or the 2 times a year thing. Today, in today's world, with how fast everything is going, how all the tax laws are changing continuously with the tax reform changes, then COVID, everything's going to be reverting into a different way after this. You really need to be meeting more often. I have a lot of investment time with my clients where I'm just, what, let's go out for breakfast, let's go out for lunch, maybe we meet for cocktails or dinner or something like that, just to, how are things going? How's operations going? What's keeping you up at night? How can we help you? And I generally don't charge for things like that either, because there's always a fear with certain clients. I'm getting charged for, for every 5 minutes I'm getting charged for picking up the phone call. That is that's not the way that you really want to have a business relationship with your accountant. I like to think of working with your accountant as an extension of your business, and there's a lot of accountants out there that do that. But I think really your accountant that you work with really needs to understand the industry, because that's going to bring you the most amount of value to ensure that you're planning things properly, you're taking the deductions that you need to, or you're deferring those into a future year, just depending on how you're planning to operate your business in any given year and what your expectations are for forecasting.
Yeah, so what I'm hearing is communicate with your accountant.
Absolutely. Communication, you can't over communicate, right?
Yeah, absolutely. And I'm guilty of that. Like, I don't talk to my accountant until April, or in this case, because Texas, we didn't have to file till June. So I'm 10 days before the deadline trying to, figure out my strategy, which is not the best thing to do.
Yeah,
So,
when that's some of the busiest times a year for tax accountants,
right.
and it's
Yep.
really, really tough. So I would recommend setting up recurring meetings. That's the easiest thing. Be proactive. Get them on the calendar now. Don't wait. And that way you've got set times established, whether it's video conferencing, which is very easy for most people these days now. COVID has really accelerated those advantages for everybody to be able to meet just like this without having to physically be present in a certain area. So I
Yep.
think that way you can talk about things, your accountant can tell you things, and you'll think of things that you didn't think about before that you really need help with too.
Yep. Absolutely. Absolutely. So I've got a question here from Eugene. And so Eugene's question is, can we take advantage of fuel tax credits if FedEx provides our fuel cards? Eugene, I think, so I guess just to provide a little bit of background for Amy, for folks that work for FedEx issues them a fuel card, picks up the bill, and then basically charges back revenue. And I think that the answer is yes. I don't think it matters by what method you purchase the fuel, as long as it's a fuel that qualifies for the credit, right, Amy? So diesel and gasoline is not going to qualify. But if you have a truck that uses electric or propane or off-road refrigeration or whatever, it would, correct?
Yeah, there's a lot of different alternative type fuels, as long as it's not being used on a motor that is propulsionary is the term that they're using. So forklifts that use propane, the refrigeration units that you need that use that fuel that qualifies, but just fuel in your truck is that you're using would not qualify for the credit. As long as the fuel expense is coming out of your pocket, you're not being reimbursed for it, you would be able to qualify for those types of credits with a certain type of usage. And you have to keep really good records should you get audited for taking the credits, because they are refundable type credits. It's very important that you keep really good books and records. And if you're using tanks and you're commingling, using that fuel for all types of different motors, you have to have a method in order to be able to document it, that I pulled it out for this type of vehicle or this type of use, to keep the qualified components and the others separate.
Yep, that certainly makes sense. Okay, so Amy, is there anything that you'd like to add on tax or tax strategy that we haven't covered?
Well, I think we've covered quite a bit, and I know I could go on and on about talking about different tax strategies, um, but I think we're good unless if you wanted to talk about something else associated with asset versus stock sales.
Oh yeah, that's a good question. Let's go there just briefly because I want to get on to finance here with Craig in just a minute. But stock and asset. So a lot of our customers at TrucksBuy buy and sell their businesses or pieces of their business regularly, and so there are advantages and disadvantages from a tax perspective for a stock versus an asset deal. And Amy, I'm going to try to explain this, and you correct me where I'm wrong, because this is something that I try to know. So if I sell my business in an asset deal, or if I'm buying a business in an asset deal, all those assets, the trucks, right, and trailers and anything that's on the balance sheet, I then redepreciate, right? So I essentially inherit them at their fair market value, and there's what are the assets worth, and then below that is the goodwill, right, in the transaction, and the goodwill can be depreciated over 15 years, right? Mm-hmm. And the assets then can get depreciated again based on their 5-year, 3-year, whatever the schedule is. But in a stock deal, I don't get that advantage, right? So if the seller of the business has used bonus depreciation and has no basis left in those assets, as the buyer, I can't redepreciate those. There's no tax advantage to that, right? Did I explain that correctly?
Yeah, that's a pretty good explanation. So if you have a stock sale occurring and for tax purposes, those assets are fully depreciated. When you sell and you have a gain, that accumulated depreciation actually turns into ordinary income, taxed at ordinary income rates. So that's one downfall in a stock deal. Well, no, that's in an asset sale. Sorry, in a stock deal, it's actually outside of the corporation, and it's going to be capital gains. You don't have to worry about the ordinary gain tax to ordinary rates, and there's no recapture, but there is the recapture in an asset deal.
Right. So I think it's important to understand that. And then there's also the liability question, because if you do a stock deal, you're kind of assuming any hidden skeletons in the closet from a liability perspective, because you're buying the stock. I mean, you still have the entity and all of its obligations. So I think the answer is consult your accountant and your attorney carefully if you're buying or selling a business, and make sure that you understand the ins and outs of what you're getting, right?
Yeah. And just to add to that and focus on in an asset deal, it's always buyer favorable, whereas in a stock deal, it's always seller favorable. But I'd say 8 to 10 or 9 out of 10 deals are always structured as an asset deal, because the buyer really wants to step up in those assets to be able to take depreciation or amortization on those, because they cannot do that in a stock deal. The goodwill associated with that gets capitalized on the books, or you have to keep it off the books until you later sell the stock in the company at the time that you're able to take that offset as your basis against any income proceeds that you receive. So what I see a lot in these deals is negotiating gross ups in an asset sale for the seller in order to compensate for any tax differentials between the two.
Yeah, that makes sense. Well, Amy, I sure appreciate your insight on tax today. And guys, if there's any other tax-related questions, feel free to post them, or finance-related questions for that matter. We're going to do more Q&A. So Amy, thank you very much. I think you provided some wonderful value. And I think that actually that discussion is a perfect lead into Craig. Craig, as a financier, how do you think about financing an acquisition if it's a stock versus an asset deal?
Yeah, that's a great question. So from our standpoint, it actually, we'll look at that and we'll take it into consideration. But at the end of the day, what we're going to be looking at is what is the collateral, what is the cash flow, and who's buying it. And whether that happens via asset or via equity, we can work with either direction. We'll want to understand the implications and how that's going to affect your cash flow. But as long as we can still wrap our hands around the collateral and around the business, we're okay going either direction. So one of the things that we look at in financing, in doing acquisition financing, is what exactly are we financing? What are the hard assets that are underlying the business? And then what kind of cash flow does that generate? So one thing that you'll want to consider, any of you that are looking at M&A transactions, is how comfortable is your bank with financing those types of transactions? I will tell you there's usually a spectrum of banks. So smaller banks have what they're going to be is probably a little more conservative. They're going to want to make sure they've got hard assets. If they don't have hard assets and there's a lot of blue sky or goodwill in that acquisition, small banks are going to look to try and get some support via something like an SBA loan, like an SBA 7A loan. Then as you get to larger banks, they're usually okay taking a little more risk. They don't always require the SBA loans, but sometimes they will. And I'll tell you the trade-off that happens as you're doing that, or I guess another thing to consider is with a smaller bank, you're usually going to get a little more personal touch, little friendlier service. You're going to not always friendlier, but at least you're typically working with a human being. I say that because depending on the bank and their culture, hopefully they're friendly, but they may not be. And then as you go to the bigger banks, it's usually harder. There's a little more bureaucracy to navigate as you're going through that. But that's a long answer to your short question. We can do either one, but we want to know what's our collateral, what's our cash flow.
So Craig is one of the nice bankers. If you
I'm one of the
can't
nice
tell.
bankers.
There are mean
look
bankers.
At his face. He's got a nice face.
That's right. So I'm going to throw another poll out here. So I'm curious how our audience is currently financing their business, and so our options here are you using traditional bank loans, or using the SBA dealer financing? Are you doing things through leases, or is there some other way? Maybe you've got a rich uncle. I don't know. Maybe there's some other way that you're financing your business. And that question applies to whether you're buying equipment or you've done M&A. I think it would just be an interesting thing to look at. So it looks like traditional bank loans and dealer financing so far. And Craig, I think to your point, SBA actually gets a lot of traction with this group in the M&A process. And I couldn't give you numbers, but a lot of the deals that we see customers transacting, and normally we have to come in and figure out all the reporting, and once the dust has settled, have an SBA loan attached. So, and I think that generally that's pretty attractive. So I guess, Craig, let's like zoom out just 1 second while folks are answering that poll. Like, what's the general state of finance? I mean, from my perspective, COVID kind of put things into a tailspin. And so for like small business finance, where are we now? Are banks hungry? Are banks, like where's the appetite? Where are the rates? What's the inflation outlook? What are some things we should know?
Yeah, you bet. So this time, maybe a year and a half ago, when COVID was first hitting the United States, there was a lot of uncertainty, and I think a lot of you saw banks really tighten up. As programs, financial aid programs like the Paycheck Protection Program came out and infused a lot of small businesses with liquidity to give you guys, to help make small businesses, allow them to bridge that uncertainty and a lot of the hardships that came with COVID. As that money has come into the market, as COVID has kind of peaked and started coming down, and the economy is picking up, banks are in this position right now where they see the outlook is generally for a strong economy, and banks also have a lot of cash on their balance sheet. And so we want to put that cash to work, and we want to go out and make loans. So I think that banks are looking for good opportunities. We want to make sure that the credit profile is still good. So that means business is viable, the opportunity is a solid opportunity for the bank. But I would say banks in general are ready to lend.
So rates, Craig, are rates low relative right now because of Fed actions?
Yep.
Or is there still like some blood in the water?
Yeah, great question. So rates right now are lower than they have been historically. So there's a lot of rate pressure out there, especially for certain loan types. So I would say equipment and truck financing, the rates are still going to be a little bit high. They're always going to be a little bit higher because there's more risk than something like real estate. But for really strong credits, rates have come down significantly. Our bank, one of the things that we think a lot about right now is inflation. And I'm sure you guys are thinking about that as well, with fuel costs going up, and it's getting harder and harder to hire workers because there are just so many opportunities out there. I read a statistic today that for every person that doesn't have a job, there is one open position in the economy right now. And that puts inflationary pressure on wages. So what that means for banks is we want to be thinking about, if rates are going up, we want to be not locking ourselves in long term because we're worried about rates going up and that eating into our margins. For you guys though, for the people getting loans, coming in now and trying to lock in a lower rate for as long as you can probably makes sense because rates aren't going to get much lower. There's really only one way for them to go from here, and that's higher. So that's kind of how we're thinking. That's how we're thinking about inflation. So does that answer your question, Flint?
Yeah, absolutely. And I think that inflation is something on a lot of everybody's mind, and nobody quite knows what to make of it because it's been a really long time since we've seen any kind of significant inflation in this country. And so what do we do? What do we do when we see inflation? So, hey, I'm curious. All right, so Craig, a lot of us on this call are entrepreneurs. I've been turned down for financing. I'll bet that there are plenty of people here who have been turned down by a bank for financing. Can you kind of give us our options and the lay of the land? So I think, we're trucking companies, so we can go to the dealer, we can buy a truck, we can finance from the dealer. And this is going to kind of get to Steve's question in the chat just a little bit. We can come to you as a traditional bank, right? We can go get a lease. Like, give us kind of high level lay of the land and what are some advantages, or SBA, what are some advantages and disadvantages of each option in the market from your experience?
Yeah, you bet. So
and maybe, Craig, let me even add to that. Maybe not only advantages and disadvantages, but as an entrepreneur, where should I look, right? Am I a better fit for an SBA or for you?
Yeah, you bet.
That's a long question, but
so before I even dive into different loan types or financing options, I think one of the things you should be thinking about is the bank that you're working with. Like I said earlier, there's kind of a spectrum, the small bank and the large bank spectrum. Large banks are usually more rigid. They can usually get you lower rates, but you're going to be dealing with a lot more bureaucracy and it just takes longer to get things done. Smaller banks may not always be as competitive on the rates, although they often are. And they're going to be a little more flexible, and they're going to lend a little bit more based on relationship. So, as you're thinking about different opportunities or different directions to take your financing, I would think a lot about your banking partner and what kind of partner that you're going to be teaming up with. So, in terms of financing types, you've got your dealer financing, which I think is available typically to larger trucking companies. And And dealer financing, they want you to buy their trucks, so they're going to offer you aggressive rates, and it can be a really good financing options for those that qualify, for those that can get it. The larger trucking companies that we bank, we rarely do any financing on their trucks or their trailers. That's all taken care of usually by the dealer that they work with. Then stepping down in size, as you come down, you've got other options that you can look at. So you've got SBA financing and bank direct financing, I'll call it that way, where we don't use an SBA program. So bank direct financing is done directly on the bank balance sheet. There's no SBA stepping in to layer on additional rules and requirements. Bank direct financing is usually going to be there for people that are more established. They have a track record. They've got several years of performance and cash flow that they can show, and good assets and solid collateral that the bank can take to do the loans. Then SBA financing is probably the next rung down. Now, there's a little SBA financing, I should say, is not always worse, and it's not always better than bank direct financing. It's another option that's available. The SBA financing was created to help entrepreneurs who maybe don't have the collateral or don't have the operational history or the cash flow, but still have the passion and still want to get into the business. And so what the SBA financing does is it gives the bank a guarantee that helps mitigate some of the risk that the bank takes on when it lends. One thing to note right now, you guys, is that through the end of September, the SBA is waiving a lot of fees on their SBA loans, and they've also increased the guarantee percentage for banks. So a typical SBA loan, a bank gets a 75% guarantee on that loan. Through the end of September, that guarantee has been bumped up to 90%. And that was done through the CARES Act. And that's something that, if any of you have struggled to find financing in the past, may make it easier for you to find financing right now. Another thing to be thinking about in your financing decision is do you have a banking partner? A lot of people think about banks as just being purely transactional. I apply for a loan, you give me a loan, end of story. I think one of the things that Amy was talking about was how to have a better partnership with your accountant. I think that same thing applies in the banking world. Do you think of your banker as a partner, as somebody who can step in and help and give you advice? And I'll tell you that the stronger your relationship is with your banker, the easier it is for them to get in, understand your situation, help suggest financing, help you to figure out areas where you can improve your financing structure, and also makes it a lot easier when the tough times come. If you've got an established relationship with your banker and you've been through some ups and downs with them, they're a lot more willing to step in and invest with you if you ever hit a hard time. And so I would say think a lot about that relationship that you're developing with your banker, in addition to thinking about what type of financing to do.
Hey, Craig, and I'm going to throw a poll out. I'm curious what our audience's average interest rate that they're paying for their financing is. And then I'm kind of curious if you can give us a little bit of color around where are you guys financing equipment right now? And maybe that's not as attractive as a dealer, and the dealer's probably getting some dollars on the truck sale, right? But just give us a kind of litmus check of, as a small business doing under, I don't know where revenue-wise we are in this group, but as a relatively small business, where is equipment financing?
Yeah, our equipment financing rates right now are going to be in the 5 to 7% range, right in there. So I would say 6% on average is where we're at on our equipment financing.
Wow. Okay. So then that's probably pretty attractive among traditional bank loans, right? And dealer might beat you, and SBA is probably not going to beat you there.
Yeah. So in fact, we could we would typically be in the 5 to 7%, even with the SBA financing. So.
Oh, okay. So another on SBA, and I don't remember, Craig, can I use an SBA loan to refinance something else?
Yeah, you can. So what you can't always do is use one SBA loan to refinance another SBA loan.
Got it.
But if you've got another loan right now, you can step in and get SBA can be used to refinance other debt. There's certain qualifications that you have to meet, but it absolutely can be done.
Right. So I see a few poll responses here that people are paying over 9% in interest. So I would encourage you guys to take a look at refinancing if you possibly can some of that debt. And the SBA, it sounds like a really good time to do that. So, Craig, do you mind if we answer a couple of questions here?
Not at all.
Perfect. So I want to grab Steve's question first. I'm going to go a little bit out of order. So Steve, and I'm not gonna read this whole question, Steve, but he's saying that what's the difference between equipment financing where there's less disclosures, they're not necessarily being given an interest rate, and there's payoff penalties and things like that. What's the difference in that versus a bank loan? This almost sounds like it's not traditional lending, because I think by law, doesn't a lender have to provide you disclosures?
Yeah, that's a good question, Steve. I'm not 100% familiar with the equipment financing that you're talking about, but yeah, that's what it sounds like to me, Flint, is it might be a non-traditional financing structure that some financing company has created specifically for FedEx. So what we will do at the bank is, we'll sit down with you and we'll disclose interest rates. We'll disclose what we're taking as collateral. We'll disclose your payment amount. All of that will be done and upfront for you. There's not as much disclosure requirements in the commercial space as there are in the consumer. Certainly on consumer loans, everything has to be disclosed. But with non-traditional financing, depending on how it's structured, that can be opaque and they don't always make it clear for you. So I would say what we think of as equipment financing at the bank is just any type of loan that's done with equipment as collateral. That's how we think of equipment financing. But we will, I'm just trying to read your question. So our loan, so a bank loan, typically does not have a prepayment penalty. It depends on the bank that you're working with, but on all of our bank loans, there are no prepayment penalties. So that can all be done. If you have a windfall, you want to pay your truck loans off early, you can do that. And that's bank direct or SBA lending, no prepayment penalty for equipment.
Yeah. So Steve, you might want to find a banker and review your options and do some math to figure out if you're getting the best deal with equipment financing. And I'm kind of like Craig. I'm not exactly sure the structure there. So I'm going to go ahead and grab Shelby's question real quick. Shelby, previous webinars are on our YouTube channel. We can email you a link to watch those. So that's an easy one. We'll check that one off. All right, we had a question here. Majority of FedEx transactions, there's not many hard assets except older depreciated trucks. So Craig, this I think is just getting to cash flow lending. I mean, this is like teeing up the SBA because that's what they're made for.
Bingo, exactly. So what the SBA would actually require is we would have to get an equipment evaluation. So even though your depreciated trucks might be down, to zero or close to zero on your balance sheet, the equipment valuation would come in and say, what does this equipment sell for in the open market? And so there actually would be some hard assets behind it. And then anything that wasn't secured by hard assets, an SBA loan would come in and help cover. So that's how we would finance the deal, is with SBA lending.
Perfect. Very good. And Shelby, I just I just added to the chat the link to our previous webinar for you. All right, so we've got another question here. So this is from Alan. Do you require personal guarantees on equipment loans, or is it a corporate guarantee?
Yeah, great question. So my bank, we require personal guarantees. And if you do SBA financing, they'll also require a personal guarantee. It's going to change depending on banks. So different banks will require different things. My feel for the market is that most equipment and truck loans are going to require a personal guarantee. Occasionally, you might find a lender that's willing to not require that. Or for larger trucking companies that have a lot of equity and a lot of assets, you may be able to get around the personal guarantee as well. But my guess is most are going to require the personal guarantee. Great question.
Yeah, I can add a little bit of color there. So there are, of our customer base, we've got several companies up in the 200 truck range, and they're still personally guaranteeing their debt when they buy equipment. So I think, to kind of Craig's point, you've got to get fairly large, right, and have a pretty significant balance sheet before banks get comfortable without a personal guarantee in most cases. So if there are any other,
go anywhere, guys. It's not like a building that sits there.
Right. Yeah. It can just disappear. That's exactly right. So I think, guys, this is a perfect opportunity. If there are any last minute questions, we've just got a couple of minutes left here in the session. As we are wrapping up, I'm going to post a link to our next session in case you are interested in registering. We're going to be talking about how to beef up your management team. So I've got to type this, I guess. So scaling up your management team, here is the link. You can register. Sorry, guys. I thought I had that ready to go. So feel free to register. That should have just popped up on your screen. For a lot of you, I know that you're growing very aggressively. And so this is something that you're going to have to tackle, and we're going to talk about it. It looks like Laura wants to hire Amy. So Laura, we will be sending, and I think someone else asked for Amy's contact. I'm going to send an email after the session to everybody that registered with contact information for Amy and Craig. So if you want to talk about tax or financing, these two folks are gems. As you heard today, they know their stuff. So, and I think that they'd love to talk to you, right, guys? I mean, that's kind of the point of this.
Yeah.
You all will find a new client or a new credit from this group of customers. So again, this session is being recorded. We will email out a link to this entire session in case you missed it or you had to join halfway through. And I think with that, guys, I want to just take a minute to really thank Craig and Amy for their time today. I think that I learned a lot. I hope that you guys learned a lot. I think that this has been a very productive session. So thank you guys very much.
Absolutely, Flint. Thank you very much for putting all of this together. And thanks again, everybody, for joining and listening to all of us.
Yeah. Thank you, Flint. Thank you, everybody.
Yeah, absolutely. All right, guys. Well, thank you very much. And I hope that everybody has a great day.
Have a great day, everybody. Bye.
All righty. Bye-bye.